Hey, it's Mark Ferguson with Invest for More, and I'm back with another real estate video. Today, I'm talking about a subject someone had asked me to make a video about to explain why I sold some of my rental properties instead of keeping them. So they wanted me to talk about return on investment compared to return on equity, which I've talked a little bit about, and I've talked about why that is why I sold some of my rentals, like this one, which was my first rental property I ever bought in 2010. I sold that in 2019 for $275,000, did a 1031 exchange, bought a larger commercial property. But a lot of people say, hey, you should just keep every single property you own. You should never sell them. You'll be in great financial shape. And that is true, but you might be able to be in better financial position if you do sell some properties, and that allows you to buy more. So in a perfect world, I could keep every single property and rent them and never have to sell them and just keep buying more and more and more. But I don't have an unlimited amount of money where I'm able to do that. So by selling some properties, doing 1031 exchanges, or maybe refinancing others, that allows me to get more money so I can buy more properties and scale faster. Whereas if I just kept stuff, didn't ever do anything, and only used income to buy new properties, it would be much tougher, much harder to scale and keep buying properties. So that's why I look at different factors like my return on equity to see if I should keep a property or sell it. So I built a little calculator that kind of goes over this too on Excel, and we'll show you some numbers, and we'll see if that helps kind of give you the idea of why return on equity is important and how to define equity too, because that can be a little bit tricky. As always, love the likes and comments, so love to hear what you think. I bought this rental property, like I said, in 2010 for $97,000 or $96,900. It was a very basic 3-bedroom, 2-bath, 2-story, no basement, 2-car garage. I bought it from an estate. I rented it for $1,050 a month after doing a few $1,000s in work. We literally did some painting, and that was about it. And over the years, the rent increased from $1,050 to $1,400, and I was getting more rent. But I also had a lot of equity in this property that I could have used to buy other properties or put in different deals. So that's something to think about when you have properties, when you're investing in properties. And even if you don't do a 1031 exchange and pay taxes on the sale of a property, it still might be more beneficial to have that cash and reinvest it into new properties. And we'll talk about why as we go through in this video. But I would love to have bought like 20 more properties like this back then. I did buy 16 rentals from 2010 to 2015, single family rentals, and I started buying commercial properties after that, and I'm still buying them now. But one mistake I made with this property too, which I've talked about a number of times, is I used the snowball method to pay off my loan, and I paid off my loan in about 3 years. And I took all the cash flow from my other rentals and just dumped it all into this loan. And a lot of people think that was amazing and awesome. Well, I could have taken that cash and bought probably 2 other rental properties instead and had 2 more rentals that tripled or quadrupled in value and had cash flow. And it would have been so much better to do that than pay off a 4 or 5% interest loan. But I did end up refinancing later on, getting some of that money out. But that was a while down the road, and houses were more expensive. And I definitely wasn't getting stuff as cheap as I did on this one. So there's a lot of different things to look at when analyzing and thinking about rentals and whether to sell or keep them. And there's no, number one right best answer for everybody. It's kind of your own individual situation. You have to think about your level of risk you're willing to take on, and how fast you want to grow, what your goals are, all of those things. So I have very expensive hobbies that are cars and automobiles. So I like to grow fast and quickly and hopefully be able to accomplish some of my dreams I've had since I was a kid in getting those vehicles and different stuff. So I'm a bit more aggressive than some people might be. So here's what the house looks like. You've pretty much seen all of it. I think we just need to go into the master bedroom now to see that part of it. Like I said, very simple, very basic, and it did very well for me as far as an investment. And people ask too, well, what's this property worth now? It's probably worth $375, so $100,000 more than I sold it for. And they say, oh, you should have held it, you should have waited. Well, it's really hard to know what the market's going to do. Timing the market is very, very difficult. But because I sold it when I did, and I bought another property, right, I didn't really lose out any equity because I probably had a higher gain in equity in the next property I bought because it was bigger. I had value add opportunities there. And that property I paid $600,000 for is probably worth close to $1 million. So I was definitely better off selling this one, buying the other one because of the big equity gain I had, much more than this one. And whenever I buy new properties, I get really, really good deals. So in that aspect, if I'm buying a new property, it almost always makes sense to keep buying and buying if I'm getting those great deals. Then if the only option is to hold or the only option is to sell and buy new, I'll take sell and buy new all the time. So let's look at this calculator I made, and hopefully this will give you an idea of what I'm talking about numbers wise. All right, so this is a Excel calculator I made, and basically here's what we're looking at. This column B is a rental when it was first purchased, and this column C is a rental property after you've owned it for 10 years. And so this is kind of the situation a lot of people find themselves in if they've bought a property a while ago and now it has lots of equity, what to do with that equity. So I put in some numbers here. I bought this property. This is a make-believe property, by the way, for 185, or sorry, I bought it for 150,000. Like I said, I always like to get good deals. So maybe it's worth $185,000, even though you paid 150, and that's possible to do in any market. I've been doing it for many, many years. The loan was 120,000 on it. Rent at that time was 1,600. Expenses were 1,100. Closing costs 5,000. Initial down payment 30,000. But your equity you had was $65,000 when you bought it, and that's one of the beautiful things about rental properties is as soon as you buy them, you can double your investment in many cases, and that's not like an albatross, crazy rare situation. It can happen on any deal you do if you're patient and know what you're doing. And this was loan pay down per year, which we'll go into our figures here later on. So after 10 years, we're saying the property's worth $400,000, which has happened for many people. There's no guarantee that will do that again, but it could if they keep having more building restrictions and making it harder on landlords and tougher on building codes. Prices are just going to keep going up and up and up. Purchase price is the same. Now the loan is at $97,000. So I use these figures from Bank Rate Mortgage Amortization Calculator, just a 5% interest rate loan. I figure that's what most investors would have had about 10 years ago. Obviously, it would be a little higher now or lower if you bought your property a few years ago. Rent now is $2,200 a month. Expenses have gone up because taxes, insurance, if you have property management have gone up. These are the same closing costs from before. Now you have $250,000 in equity. I just realized I made a mistake, so I fixed that. It's not $250,000 in equity. It's $303,000 in equity. I knew my numbers were off there. After loan pay down. So, and I had just subtracted that. I fixed it, so it's now a formula. But you have tons of equity in this house, and you're paying down $3,500 a month, or sorry, a year in loan principal now, because the longer the loan goes, the more principal you pay off, the less interest you pay. I've got some other videos on all of that, but we won't go into too much detail on this. So your cash flow now is $850 a month. Again, this could be less, more. I just want to use these numbers to give an example of the return on equity versus return on investment. So the numbers don't have to be absolutely perfect. So cash flow, when you first started, was 500. Now it's 850. Yearly profit was 6,000. Now it's 10,200, just based on your cash flow. And this is your first year gain, which is basically your cash flow plus your loan pay down plus any appreciation or getting a great deal that you had on the property. So you made $43,000 your first year, most of that because you got a really good deal when you bought the property. So that's why it's so advantageous to keep buying rentals if you can get those great deals, which is something everyone should shoot for and everyone can do. It gives you a huge initial gain. Now the 10-year gain over here is the same thing, your yearly profit plus loan pay down plus appreciation. I just assume there's a 5% appreciation per year going forward, which could be less, could be more, but I think might be more than that based on if they limit building so much with higher rates, and well, that's another story. But the 10-year gain is less, even though your cash flow is more, because you don't have that initial huge gain from getting a great deal. So what can we do with all of these numbers? Well, the ROI is return on investment. And usually what ROI is, you take how much money you invested into the property, which was our closing costs, down payments. Maybe there were some repairs and different things. We didn't count those. If you're doing a lot of repairs in a property, you probably hope you have an even bigger margin of the value compared to what you buy it for. And we take that investment and then we divide it by, well, we actually divide the gain by that investment. So our first year is a 1.23 return on investment, over 100%, 123% return on investment. And that sounds crazy, but if you get good deals, that's what happens. And so that ROI was amazing the first year. You're never going to get that high of an ROI again unless you add on, do something crazy, something really ridiculous happens. Now, that's based on the equity you gain. But if we look at ROI without equity, that just means, right, the ROI based on the cash flow you make. So we're not looking at appreciation. We're not looking at loan pay down. We're just looking at how much cash the property is bringing into you versus your initial investment. You're making 17% on that $35,000 you spent. Pretty good rental property. This is a really good rental property. These are hard to find now. Much easier to find back 10 years ago. Now these numbers would probably be a little different, especially with interest rates as high as they are. Now, your return on equity is different. Your return on equity is how much money you make based on how much equity you have in the property, or your value minus the loan amount. So the equity you would have in this property is $65,000, and you're making, you made $43,000 based on the $65,000 equity, or 66%. Now, if we do return on equity without equity, that sounds weird, but it's a return on equity just counting cash flow. So you take your cash flow, and based on your equity, you're making 9%. And why is return on equity important? Because this is money you could take out of the property and use to invest in something else. So there's actually another figure you could use here too, which would probably be important, and that's your return on equity after selling costs, closing costs, paying taxes. Because if you do sell a property, don't do a 1031 exchange, and you take that lump sum of money, you're not going to have $65,000, or 10 years later, you're not going to have $303,000. If you don't do a 1031 exchange, you might be paying, $40,000, $50,000 in taxes, maybe more, maybe less, depending on the situation. And you might be paying, $15,000, $25,000, $30,000 in selling costs, depending on how you sell it, if you use agents or not, how all that works. So you might only have $200,000 in cash coming out, not $300,000. So if you're doing it in that route, your return on equity would be actually higher because you have less money that you'd be getting out of the property. But if you do a 1031 exchange, then you'd have more because you're not paying taxes. So there's all types of different things to look at and figure that you would need to look at in your personal situation. But I just want to give an overview of the return on equity thing on this example. So your return on equity would be 66% here, based on the equity you have in the property, or just based on cash flow coming in, it would just be 9%. Now, 10 years later, we have this gain that's lower, and you've got way, way more equity. So your ROI, your return on investment, is 86%, including all the appreciation and everything. Still an amazing return, absolutely amazing. Your ROI without all that equity, just the cash flow, is 29%. Still an amazing return, right? Who wouldn't want to get 29% on their money? But the thing to think about is you already invested this money. It's already in the property. So it doesn't really matter that you're making 29% now versus 17% before. What you're looking about is if you're making 29% now on your initial investment, what are you making on the money you could take out of the property, right? Our return on equity is 11%. That's with everything considered. If you just look at cash flow, your return on equity is 3%. 3. So now we could add another figure here, and I could even do a little bit of math right here. If we do 33,700 divided by 200,000, let's say you pay all those taxes, you just have a $200,000 gain, your return on equity is 16%, slightly better. But think about this, if you sold this property and bought a new one, even paying all those taxes, or maybe you could buy 3 new properties with that money, right? Your initial ROI is going to be way better with the new properties. Your ROI in the first year is going to be way, way better. And moving forward, you're probably going to have better ROI and return on equity as well, because you're going to have 3 different properties appreciating, having tax advantages, which we didn't even count in here, having loan pay down, and you might be significantly better off financially selling this property, using that equity to buy more properties. Again, this is kind of an aggressive way to invest. It's not for everybody. It's not something that some people feel comfortable with. I do. That's why I sold some of my properties and bought new properties, because I knew I was getting a good deal. I knew I could make better cash flow and make more money, because that's something else to consider here too, is that, right, you're basically making $2,200 a month in rent based on a $400,000 value. Those aren't the best ratios. You had a better ratio when you first bought the property, and you find that with single family rentals as well. The more expensive they get, the lower your rent to value ratio is. So 1,600 compared to 185 is, if we do our math here, 8.6% ratio, whereas a 5.5% ratio. So you're making less money on these single family rentals than you were before, because as prices go up, rents just don't catch up. So that's another reason why I sold some of my single family rentals, bought multifamily or bought commercial properties, because they've got better rent to value ratio. So not only was my money being put to better use by getting a good deal by buying new properties, but my rent to value ratios are higher. So I was bringing in more cash flow with the same amount of money than I was keeping it in that property. So I know there's a lot of math, a lot of different things I just went through and over. A little bit of it can be confusing. It can even be confusing for me sometimes, because there's so many different factors to consider: taxes, 1031 exchanges, rent rates. If you do a 1031 exchange, all your money, all your cash has to go into new properties. So then you're putting much more money down usually, so you don't have as good of ROI from that aspect. So there's just a lot of things to consider. But what you really want to do, if you really want to analyze this yourself, is look at your properties you've got now, find out how much cash you would be taking out of the property if you sold it, and then figure out what you would be buying now. If you don't have anything to buy, or you can't find a good deal, that's probably your answer right there. You might want to keep it. You could refinance it, but rates are really high, so that makes it tricky too right now. If rates go down, refinancing it might be a good option too. And then you want to see how much money you can get, what you can buy, and then say, okay, how much money am I making right now? What's my cash flow? What's my return on equity, return on investment? Versus if I sold it and bought new properties over here, what's my cash flow? What's my return on investment? And then you can start to see which one is better based on the numbers and things you can write out. So it can be a little tricky and be a little confusing, but once you start writing down numbers and getting an idea of what the rents and equity gains will be, a lot of times it becomes pretty clear what the right answer is. Again, you don't always have to be perfect. You don't have to do the perfect thing all the time in life. Buying rentals in general makes you a step ahead of most people financially. So don't stress if you're not being 100% perfect and doing the right thing all the time. But if you really want to scale, grow bigger, situations like this, and selling some properties to buy more properties can often get you there faster than just sitting tight and not doing anything. Okay, thanks for watching. I know this was a technical video with lots of numbers and different things going on, but it was a request I had from a viewer, so hopefully that helps and can give you an idea of what I look at and what I consider when I'm keeping rentals or selling them.